morning. Welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. And I'm excited to have our guest this morning to talk about sort of the technology side of the business and his perspective, where we're at now, where we're going to be in the future. And I think it's going to be really good back and forth. And if you're interested at all in what sort of what's next in mortgage banking and mortgage lending, I think you'll enjoy this interview today. So before we get started, though, I want to thank our sponsors at Incelerate. Incelerate helps lenders close more loans through better borrower engagement as the mortgage industry's most innovative marketing and sales engagement platform. Incelerate CRM helps lenders manage workflow, contact strategies, lead management, referral, and realtor partners and reporting. Incelerate's engagement platform automates multi-channel marketing through social media, email, direct mail, text messages, ringless voicemail, and phone calls. It's all pre-built with the strategies and content to enable better borrower engagement. Incelerate integrates the software that's already powering your business today and into the future. And in addition, the platform is SOC 2 and SSAE 18 certified to satisfy the most closely regulated businesses, which includes banks with mortgage subsidiaries. So for more information or to check out a demo, visit incelerate.com or call the number on the that's in the description below. So with that, I want to give a real brief update on what's going on with the California MBA. If you've checked out our website this week, you're going to notice it's a little different. We've upgraded and redesigned our website, so you've got a better experience on the California MBA's website. The website is much faster now, much cleaner, much more mobile responsive. You'll find better. You're better able to see the events that are coming up. And the one thing that I'm most excited about as the communications guy here at the association is we finally have a true and I think a really helpful blog. We're going to have a member content driven blog that is live and active now. So if you are a member of the California MBA and you've got something you want to talk about and you've got something written out, maybe a blog on your website that you want us to post, we can post that on our own member content driven blog and help funnel traffic back to your website. So it's a great benefit for members. And so if you're interested in that, make sure and shoot me an email and we can talk about getting your blog posted on our blog as well. So with that out of the way, I want to welcome our guest today. Kyle Kamrooz is the co-founder of Cloudvirga. And Kyle, if you've been in the mortgage industry for any length of time, you know that Kyle is one of the best known innovators, entrepreneurs, and sort of thought leaders in the mortgage industry, and especially on the tech side. And so I'm excited to hear what he has to say here. So welcome, Kyle.
Yeah, thanks for having me.
Awesome. So let's start at the beginning. So what's your backstory, Kyle, in the mortgage industry, and how did you maybe sort of what opening did you see in the market that led you to start Cloudvirga?
Yeah, so I started in the industry. When I graduated from my undergrad, I went to I grew up in Orange County, California, specifically Dana Point. My goal was to go into Wall Street, M&A. I really loved, just understanding companies. I used to trade stocks, work for advisors, and just really understand the depths of them. Read 10Ks and 8Ks and just learn about that whole world. Specifically, this was late 90s, early 2000s, around semiconductor, telco, internet, all things, kind of forward thinking, right? Very NASDAQ heavy. So my goal naturally was New York. That was the goal. And I applied to 4 schools. And I got into basically all of them. I didn't get into Harvard. I got into Yale, and I got into Pepperdine, and I think the other school was UCLA. And I ended up choosing Pepperdine for a lot of reasons I won't get into. But I didn't want to go to the East Coast. I wanted to stay here because, couldn't get away.
Data point for the East Coast. I mean, come on.
I couldn't do it. I mean, I was such a naive kid. When I visited Connecticut, and I was just like, I looked at where's the sun and why is it so cold, right? Coming from a guy who wears board shorts all the time, surfing, it was tough. But anyways, what ended up happening is once I graduated, I finished my undergrad when I was 20. Moved up to the Bay Area. During that time is when the timing wasn't that great. That was when the kind of the internet collapsed and all the businesses were suffering at the time, early 2000, 2001. Fast forward, I was in mortgage early on. My father started in the late 90s a company, and I got really acclimated into the mortgage space, mainly on the secondary side. So I used to help my dad actually securitize loans, and I used to do hedging back in the day, bulk, mini bulk, sell to companies like RFC, Quaker Bank. I mean, these are names that, for those who've been in the industry for a while would recognize. They were no longer around. But I started with that and then started working up towards the origination. So I started in secondary and learned all the way up to the origination side, right? So how does a loan work? What is really needed from the MBS side and from the securitization side, all the way up to how do you now sell a borrower? And once I realized, that there was, the timing was actually great. This was now 2002, 2003. I ended up running a small broker shop, grew that to be one of the largest broker shops. Again, timing was a lot of it, right? Grew that to be one of the largest broker shops in California and then actually across the country. And then went and started a lender. And during the time, this is, I would say, from 2002 to 2008, I really got into the weeds of understanding the operations side, right? Even though I was technically driving the front end, right? A very call center, driving a lot of that. We did a lot of TVs. I was big on the TVs and infomercials in the early 2000s, if you remember those back in the day. And Orange County was the epicenter of mortgage, right? And so, talent was not easy, it was not hard to come by. And we just had some amazing people here. And so I started getting into the weeds on understanding the operational efficiencies, because I was starting to notice that, I had 100 underwriters, and I started noticing that why my underwriters were taking longer to underwrite a file, right? And so those metrics and KPIs were going the other way. And so what I decided to do was I actually started setting up on underwriting. Sat with some underwriters, learning the basics and the trades and so forth. Got my CHUM number, which is my FHA direct endorsement underwriter, and sat with underwriters to see exactly what they do. What is it that you do? What you're underwriting 12 loans per day. Now you're underwriting 8, then you're going to 6, right? What were the reasons beyond Dodd-Frank and all the regulations that was starting to come up? And so that really opened my eyes to a lot of the inefficiencies that were not driven by technology, given that, in my late teens, I was all about technology in different ways, right? More of a, observing and admiring some of these companies that were starting to come up. And so in 2012, we had the opportunity to really start inside of a lender to really start automating the process. And I started diagramming and actually implementing a lot of this new way of doing loans manually, which was hard because technology really wasn't there at the point where it needed to be. Fast forward to 2012, it was getting there. And at that time, we were one of the first ones. I was at a lender called Skyline, and this was a great petri dish to be able to validate some of the things we're doing, because mortgage is hard, right? And it's more than just a consumer taking an application or an e-closing being done right in the comfort of your home. The minutia is what kills you, right? And the origination is what kills you. And basically had the opportunity to build the platform inside of a lender and validate it with 300-400 loan officers in a retail setting, and a little bit of wholesale, a little bit of call center, and start validating what this new world looks like. And so that kind of led the door open in 2015, late 15, to be like, we started having other customers or other lenders come to us while we're still a lender and saying, hey, I hear what you guys are doing. Sounds like you guys are going a lot deeper than what other quote unquote digital platforms are going. We love to, look at this. And so that just gave us a very clear, reason, which is what I wanted to do all along, to really start forming Cloudvirga and really start becoming a SaaS platform, right, to power lenders and banks. So that's kind of the high level story. And since, our whole thesis has been that there's a lot of great companies out there, right? And our thesis is that we just go deeper, the origination process and understanding how that works, because we've lived it. It's not as easy as people think. And it's more than just running DU, getting a borrower to upload documents, getting day one certainty, verifying income and assets electronically. Those are all great tools, but it's the whole story. And I think what we've done and what we're starting to see in the market, especially recently, remember, we're only 4 years old, right? We're still very young in the mortgage space, mortgage tech space. And so what we're starting to see is people are realizing like how deep we really go, and all the, I would say, the things that would typically come up are not coming up for them because we're covering those bases, right? And so that's kind of how it is. And you know, our whole thesis, I would call it in the POS digital space, has always been about, yeah, consumer experience is good. We want to power the loan officer and the broker like never before. But our whole thing is how do we truly reimagine I call it the belly of the whale, the processing, underwriting portion of it, right? How do you get that piece right there? And so that's what we're really tackling.
It's interesting. I think of so many folks on the tech side focus so much on that borrower experience, and for good reason. But you make a good point that there is, that's only the front. That's, step one out of all these steps in the process to go from start to close. So, that's interesting. And you like you said, you kind of earned that knowledge, by seeing it firsthand.
Yeah. I mean, and that's right. And we've got, it's interesting when you hire, in a lot of companies, and again, great companies, but a lot of companies are like, okay, I'll hire an underwriter or I'll hire a processor and they'll give me the feedback on what I need to do. But it's not necessarily that easy, because if I depended, and this isn't a knock against any of them, right? I mean, I hired thousands of them in my career. If we listened while we were inside of the lender to exactly what the underwriters and processors wanted, we wouldn't be building the same, building what it is, right? So you've got to have the discipline of reimagining what it can be, not just replicating what it is, but just making it look prettier, right? And there's a big difference. And that's a challenge, right? Because we've come across that, right? I had some of the most amazing underwriters that gave some awesome feedback, or processors, or even loan officers, right? But it goes to the analogy to an extent. Like if you ask somebody, what's the next evolution, they'd say, the Henry Ford quote, right? Faster horses, right? And which isn't bad, that's right, because all they know is a horse, right? But when you understand from a technology standpoint what's possible, what's capable, and then understand about the vendor ecosystem, right? Which is really a big piece of mortgage, right? Because there's hundreds of vendors. I'm not just talking about credit, I'm talking about flood, title. I mean, all those pieces have to come together. And so once you understand that and understand the capabilities of these vendors and the data that they can provide, it's being able to put the story together, right? And I'm not saying we're the only ones who can do that. There's a lot of great people who can do that. It's just, there's not a lot of that, out there to be able to kind of put those things together. And so that's why we feel like we have a unique, model to it.
Yeah, and I think it's a different way of looking at it entirely, like you mentioned. So let's, I'm curious, starting a company, what were some of the, some of the challenges you faced, maybe something you do differently, something that you would absolutely do again, advice to someone else out there that's thinking about starting a business?
Yeah, I mean, specifically technology, right? I would say technology, and I love it, and it's very different than starting a mortgage company or any type of other business. Technology companies, specifically software companies, they're not tech companies. We call them technology companies, they're not. We're product companies, right? It's all about the product. And so what I recommend, and actually I talk to founders and entrepreneurs in the SoCal community all the time. And what I always recommend is be very product, maniacally focused on the product. The tech, especially now, the tech isn't hard, especially mortgage. I mean, we're not talking about anything like super advanced. We're really not. I mean, we're still on the technology side. Yeah, we're leveraging tools, but we're not advancing technology. We're not creating a new useful AI model that's pushing the needle on something. We're just leveraging basic AI, for example, or whatever it might be. Some cases of blockchain. The key is to build and validate what's the problem you're trying to solve, right? Is it a problem that's worth solving? Right? And are people willing to use it and pay for it, right? And how are you willing to delight them, right? Those are the core principles, right, of it. And as a founder, I made tons of mistakes, but as a founder, it's like you have a passion for changing a business or changing an industry or changing how the world works, which is awesome. But there's a balance of humility where you don't know all the answers, and it's about being able to learn, right, in your cohort or in the industry about what exactly is the problem you're trying to solve. Because you can have that vision, and that vision could be 100% right. The question is, how do you get there? Because you're not going to get to that vision right away.
Right.
It takes time, right? Amazon, Jeff Bezos wasn't planning on selling books. And yet, going through that run, and I remember, especially in the 90s, Amazon was just like, whatever, right? And it took him 20 years, literally, to get to the point of what he really wanted to do, which is now, right? And so there's a means to an end. He had the vision, but he needed the steps to be able to get there. So that's one thing I would definitely offer as advice. And as far as from a learning standpoint, it's just being able to maniacally focus on solving a problem and steps to get there, and try not to have too many things. Because especially, I mean, early on, like we had some of the largest lenders in the country coming out of this. And so you can just imagine all these other opportunities that were coming. And you just got to be super disciplined on when to say no. And that's the biggest, I think, attribute of a leader is it's easy to say yes. It's hard to say no, right?
Right. That's good advice. Yeah. So let's, you mentioned it a minute ago there. What do you see as sort of the, some of the major friction points in the transaction right now? How do you see, if it's a technology thing, is it new technology that's not out there yet, or is it something that is out there and we're just not using it well enough?
Well, I mean, it depends on what side, right? I mean, I can go right to, obviously, given the environment we're in with the pandemic, right, which is, you still talk to lenders. I just refinanced my house for the second time in 4 months, just because of what happened with rates. And, Chase. So I went through Chase. And they don't have any, I mean, I had to get a notary. I had to physically see them during COVID, and they haven't adopted an e-closing ability, right? And yet, and in an e-notary, and yet there's some phenomenal companies out there that are offering e-notary and notary solutions, leveraging solutions like Notary Cam, they're local here, and then also into companies like Notarize and so forth, right? Leveraging some of that technology or other proprietary technology that others are doing. So I would say that's the immediate. That I felt that right off the get-go. It's just I'm like, okay, you had me maybe do an application online. I can do some cool things. I can collaborate, text message with I don't have to go into a branch. But then I have to spend more time to figure out, okay, can the notary come to my house? Where is he going to come to my house? Am I going to go in my backyard? Am I going to do this in my garage? How am I going to do, right? I don't know if I want to come to my house. And it's just like we got to get there. So I think the immediate gap right now is some of the solutions like what Amy at DocuTech, right? Dominic and DocMagic and some of those guys are doing, which is we've got to push e-closing, and we got to get to a seamless ability where you and I, you're the notary, I'm the signer, and we got to sign my loan docs just like this without me leaving my house. And so I know it's going there. I think we just need to get there faster. Yeah. That's one immediate need, I would say. And the other one, specific to what we're doing, is it's this need to still solve the inefficiencies in the process, right? Because I know some lenders are saying, well, we're closing loans in 20 days, 25 days. I still think that's 18 days too long. And that's 7 bodies too many. I'm not just saying that we let those people go. It's just the efficiencies of it, right? And so that is still our North Star, right? Which is how do you truly, and we call it bring underwriting closer to the consumer, and therefore the broker, the loan officer, the originator, right? In our story, in our equation for CV, the originator, which is the LO, the broker, and I mean, I started as a broker. That's the center. That's the epicenter. It's not the underwriter, right? It's not the lender as a whole. Granted, it's the lender because they work for them, but the persona that we're really surrounding with all this data and intelligence is that originator. And so that's still a big need. Now, the interesting thing is for the past 2 years, given the volume, right, the cost problem of the cost to produce a loan hasn't gone away. It's just right now we're drinking from a fire hose, right? And margins are changing a little bit. It's getting a little better. But guess what? In 2000, what was it when rates were in the fours? I'd say 2015-ish, 16, volume was the cost problem, everyone was talking about it. We're like $9,500 per loan. That problem hasn't gone away. That's still there. And so the problem is we just drowned it out by the fact that we've got this flood of Kyles of the world who are refinancing every 60 days, right? And the purchase market is strong just because of rates being so low. So I would say that is still a fundamental problem because there's still a ton of inefficiencies and costs that is just being drowned out by the noise of the volume coming in right now today.
Yeah. Well, so let's future cast a bit here. You're talking about the origination side specifically. What would you say the borrower experience looks like? Maybe not just a year from now, but like 5 years from now. What are we looking at?
Yeah, I mean, I'm going to go on a limb. I'm going to say it's not very different than what it is today. And because, well, we've done, gosh, hundreds of thousands of borrower applications and whatnot. I'll give you this. In 2013, inside of Original Lender, we were doing what Rocket was doing pre-Rocket, right? 2012, 2013. What we were doing was we literally had borrowers pick their rates and products, take an application, we run DU behind the scenes, let the borrower lock their interest rate in, let the borrower self-disclose, because we had all the parameters around if I picked an FHA loan, if I picked a conventional loan, we had all those guardrails around to make sure that we disclose accurately, okay? We had borrower e-verify assets, even though day one certainly wasn't really there. We had borrower upload documents, order their appraisal, right? And we have borrowers doing this in one, all by themselves, like not even a single person involved. Now, what we learned, guess what? Was that was way too much for them, right? And then we learned the advisor is still there. The advisor is always going to be there. How their role is going to evolve it will change. But we're doing all of that. We've scaled it back. I mean, to be honest with you, we've scaled it back, which is interesting because the lender's like, whoa, hold on a second. I don't want my borrower running credit. I don't want my borrower seeing pricing. I don't want my borrower to have my 6 pieces of information. You know what I'm saying? So where I see the world going is, are borrowers going to take and do the whole thing online? I don't know. I think we've done a lot now. I think solutions like what we're providing and what others on the consumer side of taking an app, pricing product, even some of the lenders, right? Even the Betters of the world, the Deepos of the world, having the borrower self-serve. We're all in the same genre. We're all doing the same stuff on that consumer side, right? Which is EV, verification of assets, verification of income, credit, upload docs, cool stuff, bring in some data. So I don't see a big difference in where the borrowers go. Where I do see is once you solve the back office of the origination side and you solve the underwriter processor piece, what I then see is the borrower basically, maybe not in the same session that they took the app in, but maybe 30 minutes later, or maybe a couple of hours later, getting a notification saying, hey, Dustin, we're good to go. All I need is these other 3 things. Explain to me why your grandmother's on title. Explain to me when you listed your property in the last 60 days, why you did it. And I also need, blah, 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 because I found a lien on your property that shows it's closed, but it's still there, and we just want to validate it. And oh, by the way, are you willing to sign 7 days from today? We've got the, Tuesday at 7 o'clock, Wednesday at 3 o'clock available, and your notary is Bob, and they can just do it on a Zoom call, on a webinar. Just go ahead and pick a time, and we'll let you know more of the details. That's where I think the world is going to go, but I think it's going to be a little bit of a bifurcated experience where it's like the borrower starts doing this thing, but then whether it's in the same experience or 30 minutes later or same day, the system is going to basically come back to them or the loan officer or whatever and be like, okay, I'm ready to have you start signing 7 days from now, right? Obviously, given the guidelines, right, for 7 days.
Right.
So that's I see the work going on.
To say the least. I mean, it may not change the intake process, but you're right. I mean, that it certainly changes the overall borrower experience.
It's going to change. I mean, if I had certainty as a borrower, and if I can take, remember, one of the biggest headaches from borrowers, and again, being in the, I mean, I originated a ton of loans, and I've been in that market. What's one of the biggest frustrations for borrowers? Uncertainty. Yeah. Fear, right? It's an emotional thing. They don't want to get a mortgage. They'd rather they just want the house. They're not in the market for a mortgage. A mortgage is oh crap, I got to do it. I'm not, a mortgage is providing the vehicle to do it, which is important, but I'm not getting a mortgage. I'm getting the house that I want to move into because of the backyard of the pool, right? And so they're fearful, especially on purchases. Am I going to close? Is the scary lender, going to find some things about me that will deny me the process of getting a home? Those are the uncertain. And then every time I get a call from my loan officer, what's the problem, right? It's like I immediately go into this negative connotation because I'm worried. Like, uh-oh, did I do something wrong? Did he find something out? Did my loan denied? You got to take that uncertainty out. And the more we take that uncertainty out, the more pleasant it's going to be for that consumer. Having the consumer do more stuff or providing them more data in the application experience, all that kind of stuff, that's cool. I mean, okay, but it's that sense of certainty that we need to give to the borrower. And to be able to do that is you have to fix the origination process.
Right. So do you see, let's look at it from the lender perspective. So do you think that right now lenders are just not utilizing the existing tech, efficiently enough, or, is it a matter of better coordinating the tech stack, or is it, a lack of a piece of technology that's just not there yet?
Yeah, I think it's a combination of all of them. I mean, I know that sounds pretty dry, but yes, I think that it's a coordination of tech stacks, but it's also workflow. What I tell people is the hard part about what companies like us do, it's not about the technology. Like I said, the technology is the easy part. It's workflow. It's the workflow. Because you have all these investors, you've got all these different quirky products and the way they are. It's more than just getting pricing, right? And getting, it's important, getting the pricing engine, getting the data back, all that stuff. But it's way deeper than that. And so it's being able to coordinate all those permutations, right? Because, I almost say it's a blessing in disguise that we don't have the amount of products that we had back in 2005, where you had all types of products. Today, it's a 30-year fix with a slash a 30-year fix with some arms. And then you've got the gubbies, right? Non-QM starting to come back. But it's really that piece of it. So there's a piece that hasn't been solved, and how do you streamline that all in the workflow? But then it's a combination of lenders today. Again, it's what's the priority to focus on some of these things, right? And so it's I would say rates in this market have really driven some of the efficiencies, but at the same time, there's still gaps, as we're starting to see. So to answer your question, long story long, is basically, yes, I think there's still a gap that's not out there of what technology should be doing, right? And that's where we're going. We don't see anyone really doing what we're doing. And it's a combination of lender and tech stacks as well.
Got it. Yeah. So let's maybe switch gears here a bit and talk about, we haven't really got to this yet, but what about compliance, QA, regulatory issues? How does a multi-state lender, the regs are always changing in every state. Just in California, things are changing here constantly. So I'm always wondering, how does a multi-state lender, keep up on a digital platform with all these changes?
Yeah, well, I would say that a lender should keep up for the compliance because they have to anyways. Compliance is such a key piece. You're not going to automate a compliance person inside a lender, right? That's just right. The regs are changing massively, to your point. What I would say is, in regards to a digital platform or a technology provider, is you better make sure that your technology provider understands compliance really well and understands what's changing and is actually ahead of that curve, right? Not just like, oh, conventional loan limits changed. That's easy, right? But for example, LIBOR is going away, right? That's a key, one, being at the forefront. So you want to have a partner that understands the mortgage space super well and is really understanding what those changes are and how they're applicable, and does it for you in reality, right? It's like, oh, here you go. Here's an update. We updated X, Y, and Z, right?
Right, exactly. So let's, we're just about out of time here, and I want to, there's one question I always kind of like to ask someone in your position here. What's one thing that lenders don't know that you think they should know?
It's a good question. I think that lenders, in regards to technology, I go back to my original thesis, which is, and look, some of these CEOs and some of these other lenders are some of the most amazing people out there. I would say this. I would say, don't get caught up in the shiny object of rates being so low. Get back to efficiencies and dominate when the world, because the mortgage industry is very cyclical, right? This is going to pass. Now, granted, we're in the 2s and the 3s on rates. It's awesome, rosy, awesome. It might last a little bit longer, but there will be a time when volume will not be there, right? And you have to be able to dominate, and you've got to be able to make sure that the lesser the volume that you do, the more efficient you are, right? And hopefully bring that efficiency back to the consumer, because you're making that efficiency. So what I would say is, don't get caught up. Yes, it's awesome. Everyone's being in the mortgage industry is probably being the best industry in the entire country right now, right? It really is.
Yeah.
I mean, it's the best time. I think the best time, even 2003, which I thought was the best time. This is probably the best time to be in the mortgage origination business. But don't lose sight of facts. Think 5 years out, think 5 years ahead, and still try to maniacally focus on the cost problem, because it's still there. It's going to peek its head, and you've got to be able to tackle it and be at the forefront of that. So when everyone starts diminishing in volume, that you'll be able to thrive.
Yeah, that's great advice. Hey, Kyle, I appreciate the time, appreciate the conversation. I think you got I think every lender out there has got something to think about. If you enjoyed this conversation, make sure and subscribe to us on our YouTube channel. We're also on Spotify, SoundCloud, Apple Podcasts, and we'll be back next Monday morning for another episode of Connect. We'll see you then.